Everybody, welcome back to the Lending Technology Think Tank. My name is Colin White. I'm from Credit Connect Media. Hope everybody is well today. For those of you who missed our think tank earlier, we've covered quite a few sessions this morning, 3 of them in fact, on risk, affordability and digital lending, and now we're going on to the dreaded world of regulation, or not dreaded. Let's see where we get to with this. So just to remind you, for those of you who just joined us, please interact. We love questions that come in, so use the speech bubble icon that's there. There's a bit of information that you can download on the event as well, so have a look at that. And yeah, I'll talk about at the end some of the other events we got coming up as well. So it'd be great to see some people face to face later this year, although there's a lot of things against us, which are COVID, train cancellations, etc. So yeah, let's see if we can get people meeting up later on this year as well. But anyway, let's focus on the job ahead. This session, as I mentioned, we're going to look at regulations' impact on lending. This session's kindly sponsored by CallMiner. We'd like to thank them. There's a couple of things you can have a look at in our download section. Have a look at information about them. That'd be great. But yeah, let's move on and finish with our last session of the day, looking at regulation. I'm going to hand over now to our brilliant chair for the day, Chris Warburton, who's chaired our last 3 sessions. And Chris will introduce the session and obviously our speakers first. So Chris, over to you. Thank you.
Thanks, Colin. Thanks for joining. So as you say, this is the last 4th session of the day, and we're going to talk a little bit about regulatory impacts on lending. So a little bit about myself just before we start. So if you haven't been on the other sessions, my name is Chris Warburton. I'm going to be the chair for the event, director of RO strategy. Spent 20 years in really sort of in risk operations and consumer finance. Really just looking around process transformation across the risk life cycle, everything from acquisition through to the back end credit and collections. More recently, I've been doing a series of videos really looking at innovation in the industry. Obviously delighted to be able to chair this today. So as I say, so today's around regulations, and there's been regulation, I suppose, has been a consistent theme over the last 10 years or so, with increasing focus on regulation and requirements and evidencing requirements around regulation. It seems like it's been never ending the last few years, and it just feels like that bar just keeps on getting raised every single year, really. The process doesn't really seem to be stopping, and obviously we've got the big new regulation guidance that's coming through really around the consumer duty. So it's bringing new areas under regulatory oversight. There's new rules that are going to be out there. It doesn't feel like regulation's going anywhere soon. In fact, it feels like the bar's continuing to get raised. And I suppose what we want to explore here is just what are the impacts of the regulations on the lending process, and particularly in light of, I suppose, the future economic strain that appears to be coming down the barrel as if it hasn't already hit yet, which it has for certain segments. And how is this sort of change in the lending market, both in terms of cost for consumers, but also in terms of access to credit products as well, and the access to consumers. So those are some of the topics I hope we're going to sort of talk about in this session. With me, I've got a great panel who I'm going to ask to introduce themselves briefly in a minute. But we've got Frank Brown, who's on the phone, who's the Senior Director at Hogan Lovells. So Frank, welcome to the panel. We've got Jason Wassell, who's the Chief Executive at the Consumer Credit Trade Association. And we've got Frank Sherlock, who's the VP of International at CallMiner. So we've got a great panel with us. I'm going to ask each of them to maybe just introduce themselves, what their position and what their company does, just very briefly, and then we'll start with the conversation. So Frank, you're first on my screen. Maybe you go first and a quick introduction.
Yes, thanks for that, and apologies that I'm there virtually. The workcast system defeated me in terms of technology, but I'll join. So yeah, head of consulting at Hogan Lovells. We've got a small consulting practice in comparison to the size of Hogan Lovells, but we're sort of integrated with a legal team, which is quite effective in terms of supporting lending firms and other firms in the sector. So looking at, particularly at the moment with clients, the expansion into consumer duty for the regulator and how that's going to impact the marketplace. And prior to joining Hogan Lovells, I normally give people apologies for this, I was an FCA skilled person as well, so working on 166s in the sector, so sort of familiar with what the regulator wants or expects when things don't go according to plan.
Okay, fabulous. And Jason, now I go to you next, Jason.
Yeah, I'm Jason Wassell, Chief Executive of the CCTA, as you said. I've been on this role since the start of 2021, and before that I worked in other trade associations in alternative lending. Before that, if you go far enough back, I worked in strategy, risk, policy, and communications. And if you go far enough back in my career, just over a decade ago, I worked on planning for a pandemic, which was recognized as the #1 risk facing the country. So what happened there, I don't know. You know, we were thinking about back then. So how did it catch us out? That's another question for another day. As I said, the Consumer Credit Trade Association represents alternative lenders. We were founded 130 years ago to develop new innovation, new products, and create a space for non-bank lenders. Though our Victorian founders probably wouldn't have used that modern strategic language when they talked about it. But we tend to represent alternative lenders being those that have alternative products, alternative customer base, or maybe even an alternative model. And often that's because of a customer need. So home collected credit worked well for those families that would find it inconvenient to travel to a branch or an office, and has worked well for well over 100 years. Guarantor opens up credit to those that would be considered uncreditworthy. Pawnbroking makes use of family assets, and we cover a number of other sectors such as car finance, asset finance, and retail finance. We have 190 members, some of which are really small, some of which we consider to be big, but set beside the banks would be still considered to be minnows. We do have listed companies like Moss's Club and H&T Pawnbrokers, but we are here to be a kind of representative voice for those alternatives.
Okay, fabulous. And then Frank, I realise we've got two Franks now, so we have to be quite careful. Usually it's Chris's, but we got two Franks. So Frank Sherlock.
Thanks, Chris. I was going to. I don't think I've been on a panel with two Franks before, so it's going to challenge you when you start asking questions. That just ask me the ones that are easy and ask the other Frank the ones that are difficult. So thanks everyone for joining us. I'm Frank Sherlock. I'm the technology expert on today's call. I'm the general manager for CallMiner. CallMiner are an interaction and analytics company. What we do is all of the conversations the organizations have with their consumers represent unstructured data. We turn that data into structured data and provide guidance and insight for where our customers need to pay attention. We're particularly strong. We've got a long pedigree in credit collections and financial services. Within that space, we help our customers to better manage some of their regulatory obligations around complaints, vulnerability, etc., and some of their systemic issues around processes, affordability and doing the right things by the customers, etc. We allow, the big benefit, I guess, of using technology such as ours is you get a holistic view. You're not relying on dip sampling to see whether you're doing the right thing and where you need to improve. You can look across all of the interactions, allow you to really get laser focused, not just on the compliance obligations, but an important aspect, I think, particularly in today's economic circumstances, is the employee side, to make sure the employees are suitably trained and focused, but also to make sure that you're taking care of the employee well-being as well.
And I suppose to start off, I wanted to just talk a little bit. You're just talking there around sort of like regulation and consumer focus, but also around, the consumer duty is a big topic. It's the hot topic at the moment from a regulatory point of view. I mean, we've got, I think the first deadline's the end of October, where you've got to have plans in place, etc. I mean, I suppose what now that's been announced, or it's been formally announced at least anyway. What kind of impact do you think that's going to have on the industry, and particularly on lending practices? And I'm not sure, Frank, if you're still with us, Frank Brown, that is. Do you want to, if you are, do you want to just maybe take that first? I mean, what do you see in the impacts of the consumer duty, and what do we have? What impacts do you think it's going to have on the industry?
Yeah, thanks. I mean, as you said, there is obviously the milestone coming up in October, and the expectation that firms will have that presentation to the board of the project plan, which is incredibly important. In terms of the sort of wider downstream, once we actually get into consumer duty, what sort of impacts it will have, potentially quite significant. I mean, the cross-cutting rules in particular are something firms need to be very aware of. You have the concept of foreseeable harm, which is definitely going to be a challenge for some of the industry. This idea that you as an organisation or firm should have expected that problems were going to occur with the customer, that the loan was going to become unaffordable to them, which is difficult in some circumstances because we don't have a crystal ball. But equally, there are definitely more things firms can do to sort of tighten up that affordability checking.
Yeah, I mean, the idea around foreseeable harm, especially if you look at it in terms of, and we were talking just a little bit on the previous sessions around affordability and predicting affordability, and the fact that things are changing all the time as well. I mean, how do we start thinking about that?
I mean, in terms of things are changing. I mean, if you look at the current situation with obviously cost of living, which is foremost to most people's minds at the moment, and thinking around, say, electricity bills obviously going up hugely. If firms are reliant on historical data, historical assumptions, like say ONS figures around utility usage, that's not really going to stand up at the moment, because the inflation's going up, cost of living's going up so much, so they need to be sort of reflecting the reality of the world as it changes.
Yeah. So I mean, and I think we covered some of that on the previous calls, but it seems like it's got to have that future-looking view. I mean, Jason, I suppose I'd come to you, particularly for your members, and some of the things that you've been seeing. I mean, what's your anticipation of consumer duty and some of the changes that you think it will sort of like change through? I mean, I know that the industry's made a lot of changes already, but I mean, what are you sort of expecting to really transpire over the next year, I suppose?
Yeah, I think of course there's going to be an impact on lending practices. I mean, no one suggests that lenders get it right first time, and I think we'll see more of that. I mean, firms are always looking at what they can do to improve lending practices, and I think we will see improvements in issues like affordability and forbearance. I think we'll see more of that, but I think what I'm aware of is the way we will certainly see changes is that leadership will be drawn away to spend more time on the evidencing, which is kind of what you referred to in the introduction, which is how do we evidence that? I think we will find leadership drawn away to not think about innovation around lending practices, but to think about how they kind of evidence the work they've done to be compliant. More reviews, more paperwork, board papers, minuted discussions and follow-up reports. I certainly see that being an issue going forward for lenders, is that focus on evidencing. And I'm not sure how much change we'll see in lending practices. I think we'll see more changes in compliance and how compliance is done.
Mm-hmm.
And do you think that disproportionately affects smaller firms than larger firms? I mean, just from a percentage term.
Of course, absolutely. There are two things here that our members worry about and have already kind of relayed back to us, which is, do we have a true expectation of do we really understand the expectation of the regulator? And we were scarred by our experience of affordability, in that we all agreed a principle, a set of words that everybody got behind. And then it took years for us to work out what did the FCA actually mean by that. And it took years for the FCA to come back to us and explain what they actually meant by that. And that's caused problems throughout the sector. And I think we worry about that when it comes to an even wider piece, such as the consumer duty. And secondly, the leadership resource that's required will be drawn. I was asked recently by the government, why are we not seeing more innovation? I said, because leadership is drawn to deal with these kind of issues, these regulatory issues, rather than thinking about innovation. There's only so much leadership, particularly in smaller companies, as you referred to.
Yeah. I mean, and Frank, Sherlock, I was going to come to you just in terms of like, how much can technology close that gap in terms of like the evidencing piece in particular?
Wow, I mean, I mean, Consumer Duty, if you look at it, and I was reading through a couple of weeks back when the sort of final announcement came about what it would encompass, and I'll just quote something. It says, for every interaction, you need to consider the needs, characteristics, and objectives of the consumer and evidence that you've done that. Now, for every interaction, you cannot do that with human beings. You need more human beings than there are consumers to probably do that. So I think technology has a big part to play in the side that Jason referred to and Frank referred to in terms of evidencing it. I think technology can provide you, when you take a holistic view of the interactions, and can give you guidance as to where your pinch points may be. What are your calls that perhaps are more or less risky? Where have you got systemic issues? Have you got training or process issues in the organization? So I think technology has got a big part to play, but it does also, the question you just asked Jason there about smaller, technology doesn't come cheaper, but ultimately, how do smaller companies provide that means of evidencing it? So I think whilst it can help, I don't think it's the panacea of solving the problems across all different sizes of companies within the financial services sector.
And what's your assessment around that? I suppose the readiness in terms of some of the firms you see in terms of like putting some of this infrastructure in place, because it can take time to put in. But it can be so broad, or we can do it on a narrow sort of focus basis. I mean, do you think we've got a long way to go? I mean, is it quite a big? I mean, it's a big ask. Do you think it's a big ask?
Yeah, I think to be honest, most of our conversations of Consumer Duty with organisation have only really started over the sort of last 5 or 6 weeks. So that would tell me that perhaps there is a general state of, particularly, and it may be that there's other readiness within the organisations, but when it comes to technology and how technology can support them, I think we're still in the early stages of that. But yeah.
I mean, I'll go back to Frank Brown. I mean, so in terms of some of the things you've seen, I mean, what do you think the state of readiness is? And the other question I wanted to ask, just while you're chatting, I suppose, is just a little bit about, do you think the timing's been right in terms of the Consumer Duty with the cost of living increase, or do you think is it too early, or is it not early enough, I suppose? But it's good to get your sense around state of readiness and timing, really.
Yeah, I mean, state of readiness in general, I would have to say not good. For many firms, it is a bit of a conversation about I wouldn't start from here, and it is a challenge, and it's certainly the regulator is not going to be that sympathetic, because when they produced the draft rules, they were very clear of, we expect you to start your process now. So people
been a lot of warning signs, haven't there? They should warning shots.
Yeah. I mean, the October deadline was unexpected. I mean, that did come out of the blue, and that is a challenge. But in general, the sort of getting yourself ready, because we all know that between the CP and the PS, there's not a massive amount of change in the rules normally. Anyway, there wasn't a massive amount of change in the rules. So yeah, I think firms need to get their skates on if they're going to progress over the next few months, definitely.
Yeah. And do you think the timing was right? Because it does feel like the whole piece around increased regulation, it feels like the regulator's been concerned for a while around cost of living, actually, even before the recent cost of living. And there's been quite a lot of noises that have been there around, of which Consumer Duty was one. Do you think the timing's been right, or maybe not even quick enough? I mean, you could argue.
I mean, they have been frustrated for a long time, with TCF, with conduct risk, with vulnerable customers, with the cost of living side of things. I mean, they keep coming back to the industry, and in their view, they keep saying the same things. And yeah, I could see that with 166, you'd see the enforcement team voicing some issues, certainly about the market in general. And so from their perspective, they had told the industry this a lot. I mean, taking Jason's point about sometimes the messages were not that clear, but their view is this is, something that has been reflected in previous activities, previous work they've done. So they are hoping that this will be a reboot and a sort of refocus onto the customer.
I mean, I suppose sometimes it can be difficult, can't it, in terms of implementing some of these things. And I was reminded, someone said to me it was about piano scales, actually. It was kind of like, no one does their piano scales until basically they got the deadline of an exam. And it feels like it's a bit like that with regulation, which is no one does it's quite hard to get the investment or put things in until you've actually got the deadline that's actually there, and it's a hard deadline. I mean, Jason, I was going to come to you and ask, like, what do you think the readiness is? I mean, certainly come back in terms of what I said in terms of like the readiness. I mean, even in terms of like, is it unrealistic to meet the October deadline? I mean, what state of readiness do you think we're in?
I think members were waiting for the final decisions, and I think that may have been a bad decision or maybe a good decision, but it's kind of where they didn't want to move until they knew exactly what the position was going to be. It's not new, and it's not something that we just started on. We started talking about this in March of this year, and that was still, there was stuff done before that, stuff being the technical term, obviously, but there was work done before that. We talked about our conference. We had the FCA come along and talk to us at the conference in April. We did a webinar just a few weeks ago where we had 100 people on that call. So definitely there are people are paying attention, people are working on this. I think that's right. Linking the consumer duty to cost of living, the timing of that, I would say you don't need the consumer duty to help consumers through the cost of living. And COVID was a prime example of that. We moved very quickly, as did the regulator, to deal with COVID. And the cost of living is something very similar. And we didn't have the consumer duty in place there. What we had was a regulator that wanted to intervene, and they had the political and public backing. And of course, financial services firms were happy to adapt, first of all, to those kind of broad interventions around payment deferrals, but then focusing in on tailored support, which I think is going to be the focus for how we deal with cost of living, will be tailored support.
Yeah, I mean, and I suppose the pandemic is a good example about how the industry can react really flexibly and really quickly if it needs to. I mean, Frank, how much of that do you think sort of like now embedded in our ways of thinking? I mean, I'm sure we need to do more on that. But I mean, do you think we can react fast, and particularly in terms of the evidencing piece? I would think.
Yeah, I mean, I think that the taking Jason's, I don't think the two, consumer duty and cost of living are necessarily linked, and I don't think one should influence the timing of the other. But I think there is the industry, I think, faces challenges. I was reading a report from a charity, Priced Out, and it talked about the cost of living, and it talked about the fact that it most impacts people who are already financially challenged, who are spending a higher proportion of their income on food, energy, and housing, all of which are increasing in the cost of living. They've already got unsustainable levels of debt because there's not as much affordable lending around as there used to be, and they're turning to more perilous forms of lending, doorstep lenders, loan sharks, etc. And the societal impact of this sort of thing, I think, is a big priority. It should be a big priority for any government or the industry. How is it going to deal with helping those most impacted by cost of living? So that would be and that's a personal view, not a CallMiner view, but that would be.
And I suppose one of the things that we talked about in one of the previous sessions is there's a change of mix, right? So there's a change of mix where people who had less income, will still have less income, and they might have been struggling already, but they're going to also have people who were doing okay or maybe a little bit more marginal, but are now going to fall into having less money. And I suppose there are tools and techniques. And Jason, I was going to come back to you in terms of like some of the folks that your organization represents in terms of like some of the techniques. I mean, they're used to dealing with. I mean, you're going to see like a change of mix as a result of that. And like, how are we going to be able to react to that? I mean, actually, is there some of the knowledge there already to be able to handle some of these changes that are coming through?
I think we always adapt. I mean, that's what's happened. We had to adapt to COVID. COVID was not the same as a normal financial recession. It wasn't the same people that were finding themselves in difficulty. If you were somebody who traditionally would worry about financial difficulty, like say a public sector worker or somebody in big retail, traditionally you'd kind of say they're on the risk of financial difficulty. But during the pandemic, they were in probably the best financial position they've been in years. They were at 100% income and somewhere in the order of 70 to 80% expenditure. They were doing much better, whereas a nice middle-class business consultant was in the worst place ever because there was no business for them, and they were and maybe they didn't have access to furlough. So I think what happened with COVID was that people had to adapt, and I think people will adapt just now. And Frank talks about doorstep lenders, and I have to say we represent doorstep lenders. The doorstep lenders have done a fantastic job for over 130 years and served a population that has been ignored or underserved by the banks. So I make that point, Frank. I know you'll understand that's our position. But I do worry about what he's saying, where it goes to, does it go further than that to non-regulated lenders? And I think there's plenty of evidence there that we're seeing non-regulated activity growing, both in terms of real absolute criminal activity, such as illegal lenders that are linked to organized crime, but also other products that are outside of FCA regulation, like buy now, pay later, salary finance, all of these things that sit outside of FCA regulation, but are growing fantastically at this point.
Do you think that, I mean, we seem to be on this trend of increasing regulation, right? And that adds costs to businesses. I mean, do you think that that's pushing some lenders out of the market because of the cost of doing business or the cost of evidencing? And is that creating a gap? I mean, is that a good thing or not? Because on one hand you've got the regulation around bad practices, but the other thing is you're increasing the cost for some businesses as well.
I think we have a market, and I say this as somebody who represents alternative lenders, but once you're out of prime, the choices are much less for you. Once you're out of prime, your choices are limited. And that's only got worse in recent years with departure of many lenders. Short-term lenders, we saw the best part of 1 million customers lose that option. Then we saw Provident and non-standard finance leave home collected. That's another couple of 100,000 customers lose that preferred lender. Guarantor lender is lost out. Pawnbroking is going down. The numbers tell a story of decreasing supply, and demand is not dropping, I've got to tell you that. And while some might welcome the departure of those firms, it's just creating a gap, which leads to some of the problems we're talking to there in terms of the kind of introduction of organized crime and unregulated products that don't have the protections that regulated products do. You will be able to rely on forbearance. You'll be able to rely on all the kind of protections that a regulated lender does if you work with a regulated lender. But once you're out of that, you're open to God knows what.
Yeah. I mean, it does seem like the direction, certainly with buy now, pay later being included or going to be included. I mean, it feels like the direction is, I was going to ask Frank Brown, just in terms of your view, in terms of like what's going to be included. I mean, is that the direction of travel, do you think, from your experience, I suppose, in terms of like more and more is going to be included? And does it create this almost like gap at the other end, almost like unintended consequence, like Jason was saying, around people being pushed when they can't access the market? Or do you think that's maybe not the case, or it won't be quite the risk that we're kind of thinking about?
I mean, I actually started my financial services career with Provi, so I know the sector well and know what role they played in the communities where they're in, and that is gone now, as Jason said. And the supply has gone, but the demand has not gone with it. The demand has not changed. So, yeah, certainly I think there will be some challenges. I mean, two sides of it. One, companies not feeling they can cope with the sort of administration load of regulation, particularly smaller companies, but equally the threat of claims management as well. I mean, claims management companies will be reading this new principle avidly and thinking about it. And we've seen lending companies be sort of targeted, get focused on by claims management companies, which has been problematic. So I certainly do think that there will be some pressure on the supply, which is possibly an unintended consequence of this. In terms of the expansion of the market, things like buy now, pay later, logically, it would be expected that it would be coming under consumer credit, and obviously slowly that's going to happen over the next time period. And I think the regulator does want to try and, from its its slow start in 2014 when it was getting to know the market, now is thinking, yes, I want everything that is effectively credit within the regulated area. Yeah.
Yeah. And what do you think the solution is for the increased cost burden, particularly for smaller firms or some of the innovative firms? I mean, do you think, is there a solution there in terms of like evidence requirement, or is it technology? I mean, Frank Brown, and then I'll come to you, Frank Sherlock, just around like some of the solutions that could be there to sort of keep the supply for some of those customer base who are looking for that kind of credit.
Yeah, I mean, there's this sort of classic competitive advantage point around size that, larger firms can absorb more administration costs than smaller firms inherently. They've got better, bigger economies of scale. That's a sort of, universal truth, which is always going to be there. In terms of helping smaller firms or aiding them, technology, the RegTech technology has improved enormously and is driving forward with AI as well. Can be very helpful indeed in managing that workload. Things like the sort of broader concepts like sort of recruitment, training, development, that kind of side of things as well too. If you get the right people, you train them up right, and they've got the right culture, less oversight is required. I mean, I know it's a bit of a sort of ideal scenario, but it is part of the mix that sure people,
Yeah. I mean, Frank Sherlock, I mean, how much do you think technology can close the gap, particularly for the smaller firms?
Yeah,
I mean, obviously there's the cost involved in that, which you already talked about. But I mean, do you think it's something that can help sort of alleviate those economies of scale?
I think so, but I do think there's perhaps an onus on the technology providers to perhaps make it more affordable, technology as a service, giving economies of scale rather than providing technology on a sort of one-to-one basis to individual companies. So that I think that it can help, but I think we've got, within the tech sector, we've got work to do, I think, to make the technology more affordable and accessible at the lower end of the market for smaller companies.
I mean, what's the panel's view? Do you think that, I mean, if we do get into we're going to get into an energy crisis in the winter, we're talking about weather earlier in terms of like what the impact is if it's a cold winter or cost of living. I mean, do you think the regulator will react further if there's, and it's almost like there's a danger that there could be a knee-jerk reaction to distress across portfolios politically. I mean, did you think that could occur?
I think, just from our perspective, I think it could occur. It could easily occur. I think that people should be reassured that the FCA is being very clear. It's talked consistently and continually with members of ours about the cost of living and has made it clear that this is a priority and that people should be working on it and should be working through their solutions or their ideas. So I think it's fair to say that the FCA is putting a huge amount of pressure on firms to move forward on this. There's not much more they can do there, but I think there's always the worry that in a very politically charged atmosphere that they opt for something that is knee-jerk. That could happen.
Yeah. So I mean, particularly with the changes, even the changes that are going on today, the politics seems to be changing figure. I mean, Frank, there was even some conversation around sort of collapsing regulators together. I mean, what I don't know, Frank Brown. I mean, you probably saw that with those things, the PRA and the FCA being merged together. Do you think that's a likelihood, or am I just completely in speculation territory there?
I mean, obviously, new Prime Minister coming in, and she and the team have got a lot of ideas. It is certainly possible that they will revert back to the model, the single regulator model.
Do you think that would be a good thing? Do you think that'd be a good thing? Or?
I mean, personal view, and it is a personal view. Not. I think that they were split, and there's good reasons to split them, and they are performing different functions. you got the PRA very prudential focus, very macro focus with large organisations. FCA much more customer outcomes focused. To blend those together again, I think would be quite difficult.
Yeah. I mean, would that be something that would, I suppose, worry? I mean, maybe not from an evidencing point of view or a technology point of view, but more from a consumer lending point of view. Maybe Jason, I don't know. I suppose we don't know what's going to happen. I suppose is in summary. You're on mute, Jason. I got your mute.
Sorry, I've got a building site going on next to me, which is why. But I think for those of us that are regulated solely by the FCA, I think we worry sometimes that they don't take the macro view. They don't. It's very hard for them to look at, what is the impact of credit across the economy, what's the impact on families. I think sometimes they are too focused on consumer protection, and I say that recognizing consumer protection is important, but it has to be balanced with other objectives. And I think sometimes they place other objectives to one side, the objectives around competition and a vibrant market. That we don't see any evidence of that in the sectors that we represent. I think that there might be benefit in having one regulator that deals with all of this. The problem being the restructuring will delay activity for years as we go through this. And I think just the practicalities of that would put us off. But from a philosophical point of view, I don't think it's a bad idea. I just think practically it would be a distraction and nightmare.
Yeah. I mean, have to see how things transpire, I suppose, over the next couple of weeks. I mean, Frank, I was gonna come to you just in terms of back on the technology piece, and particularly the RegTech piece and using technology. I mean, just in terms of this power of using technology to find areas of non-compliance, and that whole piece around evidencing. I mean, again, what should our priorities be? I mean, it feels like it's consumer. I mean, it's consumer-based legislation looking for outcomes. Is that really where you guys are focused, or you think the industry should be focused?
Well, yes and no, Chris. I mean, I don't think there's a straight answer I can give you. Certainly for our clients, it's around managing their regulatory and their compliance obligations, but it doesn't stop there. If you think something like cost of living, it affects the contact center workers who are providing a service on behalf of the organization. So, how can they use technology to better train and enable and support their own staff who are impacted by this as well? So, more and more where we have conversations around that whole employee engagement and employee well-being, and how can we use technology to allow them to better solve that dilemma? So it's both sides of the coin, Chris. Absolutely, day one, our raison d'etre and what people use our technology for within the financial services is around regulatory compliance, automation of quality assurance. But more and more now, we are moving towards the quite rightly the employee side of the equation as well. And then there's other areas that we help them with in terms of brand intelligence or product intelligence, revenue cycle management. I was talking to a couple of our customers that I'm doing a webinar with in a couple of days, and the webinar is really about the cost of living and what technology's done to help them. And there's some interesting just factoids that came out of the prep conversation in terms of call handle time. So how long is it call handle times increasing by a significant amount in a lot of complex conversations. But when they do it properly and appropriately, actually the levels of forbearance are lower. They're achieving lower levels of promises to pay, but most of the promises, a higher proportion of the promises are kept. And technologies help them to I think get to manage these complex conversations and to a better outcome for their organizations and for their customers.
I mean, certainly part of the Consumer Duty was talking around sort of like trying to match communication channels, matching those that could actually, the customer kind of wanted, right? I mean, so there's some of the investment that we've, I suppose, kind of talked about in the industry for the longest time seems to be flowing through to the regulatory elements too. It feels like, I mean, because there's that sort of like symbiosis, I suppose, between what we kind of do in the industry and then it getting regulated, and then we're told not just what we wanted to do, but then what we now have to do it to a certain extent, which is a good thing in some ways, but I suppose also adds costs in another kind of way for some firms that maybe haven't kept up or don't have the infrastructure or the size to be able to do it. I mean, Jason, looking at, I suppose, some of the comments that you were kind of making. And I suppose just to sort of to finish up here, I suppose to a certain extent, I mean, what do you think are some of the biggest challenges do you think lenders are going to face over the next sort of like 12 months from a regulatory point of view? I mean, do you think where should people have their focus? I mean, with Consumer Duty maybe being one. I mean, Frank, Frank Brown, do you want to just maybe take that first?
I mean, the immediate challenge is certainly around meeting the October deadline and providing the board with a sufficient detail that they can actually make an informed decision of whether the plan's going to work or not. Because firms really should be treating this as effectively as an attestation. This is evidence that the regulator will look at if things go wrong in the future. So meeting the October deadline, focus on that, that'll be important. And then looking at the business model and having that honest conversation internally about our processes, our prices, our approach. Is that going to be sustainable in the new world going forward?
Yeah. And do you think firms are going to be at risk if they don't meet some of that? I mean, how much scrutiny do you think there's going to be, or how much risk, I suppose, maybe regulatory risk rather than financial risk? But I mean, how much risk do you think there is around for some firms about not meeting those deadlines?
I mean, there is absolute risk baked in from October in terms of firms saying, yes, this plan was suitable, and then trying to progress it. The point is always going to be, will the regulator actually turn the spotlight on that individual firm? Yeah. And for smaller lenders, mainstream lenders, it doesn't happen all the time, certainly, but it does happen. And like I said, I used to be a 166 skill person, and some of the firms I was working with were relatively small, relatively innocuous in the scheme of things. So it can be the luck of the draw sometimes, but it's not, it's not going to be every firm that's going to be viewed, definitely.
But it's a roll of the dice, it sounds like. To a certain extent.
Yeah.
And Jason, what's your kind of view in terms of the next kind of 12 months? I mean, what needs to be the focus? What do your firms, I suppose, and you guys need to be focused on? Are you going to be focused on?
I think we've covered the kind of two of the big themes in this session around cost of living, the challenges of helping existing customers and finding new customers where that's appropriate, and ensuring that you abide by the regulation and any kind of new kind of intervention that comes along as the FCA seek to kind of tackle the cost of living. So I think that's obviously going to be something that will kind of will attract the leaders of our members. They'll be interested in how do we deal with the cost of living, both in terms of existing customers and new customers. And then the regulatory work involved with the Consumer Duty, as I've said before, of particular concern to smaller members, as the resources required, the leadership, not capability, but capacity. Do you have the capacity to do this? I think that's going to be problematic. And as I said, there's this question here about how do we ensure we actually understand what the regulator is seeking, what their expectations are. And that's something for all lenders to be asking the FCA. We've got to make sure this isn't the end of the dialogue. It's very kind of Churchillian, isn't it? This isn't the end. It's not even the beginning of the end. It's the end of the beginning. We need to do something like we have to keep talking so that they explain to us, what do they mean by what was fair value but has become price and value? What does that mean? What does that mean for our sectors, particularly when we've got subprime and near prime and we have to explain what our costings are and why we're so costly compared to the prime. There's lots of things there that need further discussion, more technical discussion. It needs the FCA to engage as well. We can't go away and do it by ourselves, or else we'll come back in 3 years' time and we'll find out we got it wrong. So there's something hard to be done here. There's a dialogue that needs to continue from now.
And I mean, and that's something that I suppose you're saying you want to change from what happened before, where it was much more sort of, I suppose, principles based or guideline kind of based, and sort of maybe making it a little bit more specific would be a big help to the industry.
We asked for more guidance, and that was one of the. I mean, I've got to say the FCA asked us for how they could help coming into this, and one of the things that all the trade associations said, or all the smaller trade associations, I would say, all of us said together that we need more guidance. They needed to be more specific around certain issues and certain principles, and we got that with the non-handbook guidance. There's more information there than we would normally get, but this can't be the end. We've got to keep going. Yeah.
So it sounds like it's going to be an ongoing dialogue that needs to take place, and specificity, if I can say it, I suppose helps with then evidencing, helps with technology, helps with building processes around that, and those kind of things. I mean, Frank, just going to on the technology side, I mean, it's much. I mean, what do you think is going to be the focus? I mean, given what Jason just said around sort of getting specific requirements out.
My fellow panelists live and breathe in the industry every day, so I can give the conversations I have with our customers in the space center really around helping them to manage higher levels of indebtedness brought about by the cost of living issues, helping them to deal with an ever-changing regulatory environment. The flavor of the day at the moment is consumer duty, and then just more broadly the higher levels of vulnerability in the client base, not just financial vulnerability. The impacts of cost of living on mental health, and because of lack of self-esteem, people who are skipping meals, and therefore there's physical vulnerability, and more people may find out that they're digitally vulnerable. They're not able to communicate in the way that they communicated with their organizations on the wonderful self-service channels that have been put in place, because they may not be able to afford the home broadband or the mobile plans that they had before. So it's really a number of factors, I think, Chris. It's regulatory compliance, it's vulnerability, and it's cost of living. They're the three things that my customers in this sector sort of keeps them awake at night thinking about.
And I suppose they're all kind of interlinked, aren't they? In terms of vulnerability, you've got financial vulnerability, and I suppose technology's got a role to kind of help identify some of those kind of customers.
Yeah, they are all interlinked.
Yeah. Well, I'm going to at this point I'm going to thank the panelists. I think it's been a very interesting discussion. I know we had a few issues. I think my camera went off at one point, so apologies if I've disappeared. I'm not even sure if I'm still on the screen actually. But thank you to Frank and Jason for a very enlightening discussion. I think it was certainly I've learned a lot of new things, and we're looking forward to that October deadline, and then more changes to come, and more changes to come over the next couple of weeks as well. So thank you very much. Really interesting stuff. I appreciate it. So Colin, I'm going to hand back to you on that at that point.
Yeah, thanks, Chris. Appreciate that. Thanks, Jason and Frank for the discussion. Really, really interesting as ever. Like you say, Chris, there's more news to travel through this year before we go anywhere. So yeah, interesting times. And on that note, just wanted to say that we are looking to run our face-to-face credit and collections think tank on the 17th of November at the Midland Hotel in Manchester. So if people want to join us for that would be really good. But I just want to round up really and say, first of all, a big special thanks to our sponsors for today. Really helpful. So that would be Experian and CallMiner. Really thank them for their support on this event. We wouldn't run these events without them. So really good. Thank you for that. As I mentioned, we've got other events coming up later this year. We've also, so I mentioned on the 17th of November in Manchester, we're running the think tank. After that, we're running the Credit and Collections Technology Awards. So if you want to attend that, then sign up now. That'd be really good. So that's also on the horizon later on this year. But yeah, just wanted to finalise, thoroughly thank all of our speakers today across all 4 sessions. I hope you all agree it was really interesting debates and really interesting speakers from a variety of lenders there, really. And obviously the association and regulatory angles as well was great. So thank you to all of those speakers. And of course, if you want to find out more about our forthcoming events, face-to-face and even virtual that we're planning for next year, we will continue with the virtual. There's definitely an audience there. And with things like train starts in the way, etc., as well, then there's always going to be a space for them, unfortunately, at the moment. So yeah, but let's round up by saying thank you for everybody who's attended today, asked questions, been part of the event. We're going to have a write-up of the event on the Credit Connect website around about next Tuesday, cover some of the questions, some of the event polls that we had today. But for now, I'd just like to say thank you for everybody who's attended, and especially to our host and chair, Chris Warburton. And we hope to see you all again soon. Thank you very much. Cheers. Bye.
Thank you. Bye.